The Nasdaq just fell for 5 straight sessions. That is not a random data point. That is a pattern with a very specific cause. And once you understand that cause, you will never read a market sell-off the same way again. Here's what happened this week. Tech stocks declined across the board. The Nasdaq Composite lost 0.24% on the week. The VIX, the market's fear gauge, flirted with 20. AI stocks sold off sharply. Chips pulled back. Even the names driving the first half rally took a hit. And Wall Street blamed a dozen things. Rate hike expectations, oil prices rising, Middle East uncertainty, the Iran ceasefire holding but fragile. Those things are real. But there is one explanation that keeps getting buried in the headlines. Nathan Peterson, director of derivatives research at Charles Schwab, said it directly. Some of this sell-off is quarter-end rebalancing by pensions and sovereign wealth funds. Let that land for a second. The biggest sellers in this market right now are not scared retail investors. They are not hedge funds making speculative bets. They are pension funds. They are sovereign wealth funds. They are the most disciplined, most powerful institutional money managers on the planet. And they do this every single quarter. Hold that thought. Because understanding what they are doing and why tells you something far more useful than any earnings headline. Let me walk you through the timeline. At the start of 2026, markets were strong. The S&P 500 climbed steadily. AI stocks surged. Chip companies broke records. The first half of the year delivered one of the best 6-month runs in recent memory. Now here is the problem with strong rallies. Every institutional investor has a target allocation. Let us say a pension fund wants 60% stocks and 40% bonds. After a massive tech rally that pushes stocks to 70% of the portfolio, the math breaks. They are now overweight equities. Specifically overweight the stocks that ran the most. Specifically overweight tech. To restore balance, they must sell. Not because they think the market is crashing, not because they are panicking. Because rebalancing is literally their job. And they do it at the end of every quarter. That is exactly where we are right now. The final week of June, the end of Q2, the books are closing on the first half of 2026, and the biggest institutions on earth are systematically trimming their biggest winners. Now here's what this pattern actually looks like in history. Quarter-end tech sell-offs driven by rebalancing are not new. They show up at the end of almost every strong quarter, and they almost always share the same fingerprints. High volume selling in the sector that ran the most. VIX rising toward the 18 to 20 range. Bond yields moving as capital rotates. Broader indexes holding up relatively well compared to the specific names being trimmed. Check, 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 and check. Every single one of those conditions is present right now. The S&P 500 is down fractionally, but the Nasdaq is down 5 days straight. That divergence is the fingerprint. If you find that kind of market analysis useful, consider subscribing for more practical financial insights. Now here is the part most investors completely misread. They see a 5-day Nasdaq losing streak. They see VIX climbing, they see tech selling off, and they assume something is fundamentally broken. But institutional rebalancing is not a fundamental breakdown. It is a mechanical process. It ends. And historically, when institutional selling finishes and books close for the quarter, markets often stabilize quickly. The pressure that built up over weeks of rebalancing releases, and the market finds its footing again. That does not guarantee a recovery. The macro picture still matters. PCE inflation data this week showed supercore inflation tracking at 3.9% annually. That is high. Rate hike expectations have eased but have not disappeared. The Fed's new chairman Kevin Warsh is watching every data point closely, and Thursday's jobs report, released a day early ahead of the Independence Day holiday, could shift the entire narrative in either direction. A strong jobs number pushes rate hike fears back onto the table. A weak jobs number gives the Fed more patience. Neither outcome is guaranteed. But here is the thing. Whether jobs come in hot or cool, the rebalancing pressure that drove this week's sell-off is largely over by Friday. The quarter ends today. The books close. The institutional selling cycle resets. What you are watching right now is seasonal, structural, and predictable. And here is what that means for you specifically. If you are a long-term investor who saw your tech holdings dip this week, understand why before you react. This was not a signal that AI is over. It was not a signal that Nvidia, Broadcom, or Microsoft are suddenly bad businesses. It was pension managers doing arithmetic. They owned too much tech. They trimmed. The price fell. That is the entire story. Now consider this angle. If institutions were forced to sell their winners this week, that means they were also buying something else to rebalance. Capital does not disappear, it rotates. Bond markets showed some of that rotation this week. 2-year Treasury yields dropped nearly 9 basis points. 10-year yields fell 8 basis points. 30-year yields pulled back slightly. That is a bond rally happening quietly beneath the tech headlines. When large institutions sell stocks and buy bonds to rebalance, yields fall. That is exactly what happened, which means the bond market this week was not telling us that the economy is weakening. It was reflecting institutional mechanics, and that distinction matters enormously. A weaker economy would send stocks and bonds in very different directions for very different reasons. What we actually saw this week was coordinated institutional repositioning. Now here's where things get interesting for everyday investors. Quarter-end rebalancing creates short-term dislocations. Prices move not because fundamentals changed, but because large players had to adjust their books. Those dislocations historically correct, sometimes within days, sometimes over a few weeks. The question you should be asking is not whether tech stocks fell. They did. The question is whether the underlying business case for those companies changed this week. And by every measure available, earnings, revenue growth, AI demand, it did not. GDP was revised upward to 2.1%. Q2 growth is tracking at 2.5%. The labor market has added momentum through the year. Consumer and business spending remains solid according to Edward Jones analysts. That is not the backdrop of a market in structural trouble. That is the backdrop of a strong economy with institutional math creating a temporary price dip. History also tells us something else important. The second half of the year tends to benefit from the first half rebalancing pressure releasing. Markets that experienced heavy institutional trimming at mid-year have historically shown above-average performance in Q3. Not always, not guaranteed, but the pattern is consistent enough to pay attention to. The first half of 2026 was strong. That strength created the rebalancing pressure. The rebalancing pressure created this week's selling, and that selling cycle is now ending. What comes next depends on jobs data, Fed guidance, and whether the Iran ceasefire holds. But the mechanical pressure that pushed the Nasdaq down 5 days straight, that chapter closes today. That is what the data is actually showing right now. What you do with that information is up to you.